Welcome to the deep dive. Today, we're tackling a really interesting puzzle. This recent rebound we've seen in Indian equity markets, since about February 2025.
That's right.
We've gathered quite a stack of market data, some expert analysis, and our goal today is really to cut through the noise, figure out how solid this bounce actually is, and, well, what it really tells us about where the market might be heading.
Yeah, and we've got a pretty comprehensive set of sources to work with here. We're talking detailed charts on the big market indices, Sensex, midcap, small cap, but also, importantly, a closer look at market breadth
Okay.
and things like valuations, earnings growth, which is crucial, and then stepping back to the bigger picture too.
The macro stuff.
Exactly. GDP, trade figures, some of those high-frequency activity indicators, wage growth trends, and even a look at gold versus silver for some wider context.
Right. And for you, listening in, what we're really aiming for is clarity. What are the key takeaways from all this data? What are the, essential things to keep an eye on in the Indian equity story without feeling completely buried under numbers? Okay, so let's dive right in. This bounce we've seen, what's the first thing that jumps out when you look closer?
Well, the market certainly did bounce back pretty sharply from those February lows, that's true.
Yeah.
But when you look under the hood, so to speak, the market breadth actually looks quite weak.
Weak breadth, meaning?
Meaning we're seeing more stocks hitting new 52-week lows compared to those hitting new highs.
Ah, okay. So the main indices might look good, but it's not like everyone's joining the rally.
Precisely. And, another piece of evidence for that narrow participation is the low percentage of stocks trading above their 200-day moving average.
Right, the 200-day moving average, that's basically the stock's average price over the last, 200 trading days,
Yeah.
often used to gauge the longer-term trend. So if only a small percentage are above that line, it suggests the overall momentum isn't that strong, like only a few star players scoring the points.
That's a good analogy. Yeah. This kind of narrowness can often be a sign of, let's say, underlying fragility in the market recovery.
Okay. Now let's talk about the small and mid-cap stocks, the SMIDs. Historically, these are often the exciting ones, right? The ones that can really take off during an upswing.
They definitely tend to outperform the large caps in bullish periods. That's the allure, potentially higher growth. But, and this is crucial, you have to remember the other side.
The risk.
Yeah, the risk. In down markets, SMIs typically give back a very significant chunk, sometimes all, of those extra gains because they're just more volatile.
Higher potential reward, but those rewards can vanish pretty quickly.
Got it. So what's the picture for SMIs right now?
Well, what's really interesting here is that the big outperformance phase for SMIs, it seems to be, winding down, at least for the time being. We're starting to see what analysts call mean reversion of SMID excess returns.
Mean reversion.
Yeah.
Sounds technical. It just means they're starting to perform more in line with, or even worse than, the average. But simply, on a one-year rolling basis, SMIs have actually started to underperform the large caps.
Ah, okay, so that momentum has shifted.
That shift is a really key signal to watch, yes.
Interesting. And I gather the valuations in the SMID space are also looking a bit stretched?
They really are. If you look at the total market value of all SMID companies compared to India's GDP, that ratio is quite elevated right now. It's sitting above 50%.
And normally it's.
The long-term average is around 27%. It actually peaked back in September 2024 at a whopping 64%. So still high.
Wow.
And on top of that, the valuation multiples themselves are high. We're talking around 33 times trailing earnings.
33 times.
Yeah. And this is despite them delivering only single-digit earnings growth for the past year and a half, 6 quarters basically, alongside a return on equity of about 14%.
Okay, so you're paying a high price, but the actual profit growth isn't really backing it up. That sounds problematic.
It is, exactly. This gap between the high valuations and the, relatively weak earnings growth
Yes.
leaves investors with a very thin margin of safety.
Margin of safety, meaning room for error.
Pretty much. If things don't go perfectly, there's not much cushion. And historically, when we've seen valuations this high without strong earnings support, the market often corrects. That can be through sharp price drops or sometimes just a long period where prices go nowhere while earnings try to catch up.
So that extra performance the alpha investors chase in SMIDs, it sounds like it can just evaporate.
That's really the core message here. History shows that the excess return you might get from small and mid caps in the good times is very often completely wiped out when the market turns down. So given where valuations are now and this emerging trend of underperformance, maybe sticking closer to large caps is the more prudent option for now.
Okay, that makes sense. Let's maybe zoom out again, look at the broader market through the Nifty 500. What do those overall stats tell us about this bounce? Is it confirming the SMID picture?
Yeah, largely it is. The Nifty 500 data pretty much echoes what we saw with the general market breadth earlier. More stocks hitting 52-week lows than highs.
Still narrow then.
Still narrow. And similarly, that percentage of stocks trading above their 200-day moving average, even for the Nifty 500, remains weak. It just reinforces the idea that we don't have a strong, broad-based uptrend established yet.
And those charts you mentioned showing the SMID market cap to GDP ratio over time, what's the key takeaway there beyond just saying it's high now?
Well, those charts clearly show peaks in the past, I think 2007, 2017, and then again in 2024. And after those peaks, the ratio tended to fall.
Right.
The fact that we're still at a pretty high level, even if off the absolute peak, suggests this SMID segment might be in for, a period of correction or just underperforming the wider economy.
And there were charts showing relative performance too.
Yes, charts tracking the one-year rolling performance of the BSE small cap and mid cap indices versus the Sensex. They visually confirm this recent weakening trend we talked about. They've started lagging behind the large caps.
Okay. The analysis also mentioned looking sector by sector within SMIDs. Any bargains hiding there?
That's the tricky part. That sector view really highlights how difficult it is to find compelling value in the SMID space right now.
How so?
Well, even in sectors that might look cheaper on paper, like maybe FMCG or paints.
Right, consumer goods.
Yeah, they face their own headwinds. FMCG has sluggish growth, paints are facing industry disruption, and then you look at sectors with good margins like defense or industrials, and you see their order book growth starting to slow down.
So no easy pickings.
Not really. The overall picture is that finding genuinely undervalued SMID stocks that also have strong fundamentals is, frankly, quite challenging at the moment.
Which leads us neatly into this concept flagged in the analysis, the risk triad. Slow growth, margin contraction, and elevated valuations. Let's break that down.
Yeah, this is a really critical combination to grasp. First, corporate India is generally dealing with pretty slow single-digit sales growth overall. Now, there is some revenue recovery happening, but it seems to be driven more by companies spending on CapEx or innovating rather than just a broad wave of consumer demand lifting all boats.
Right.
At the same time, number two, many companies are feeling the squeeze on their profit margins. Input costs might be rising, consumer spending is a bit soft.
So costs up, demand maybe not so strong.
Exactly. And many sectors were already operating at pretty decent margin levels, so there isn't a lot of scope left to, expand margins much further to boost profits. So slow sales growth and limited room for profit improvement for margins.
And you mentioned falling crude oil prices. That's not helping enough.
It provides a bit of relief on the cost side, sure, but it doesn't seem enough to really counteract these bigger issues across the board. Plus, you've got other headwinds like weaker export performance and that slowing wage growth we'll probably touch on later. All that drags on earnings potential.
Okay, slow growth, margin pressure, and the third part was valuations.
Right. And despite all these challenges, equity valuations, as we've discussed, are still quite high. They seem to be pricing in a really strong profit recovery that, might not actually happen given the headwinds.
So if those high earnings expectations aren't met, what's the big risk?
The primary danger is a significant market correction. Valuations basically reset downwards to match the underlying reality of earnings and growth.
And how high are valuations now in that context?
Well, the current price-to-earnings ratio for the Nifty 500 is hovering around 32, which is, historically quite elevated. And it's not just domestically. Indian midcaps are trading at a significant premium compared to the long-term average for global midcaps.
A premium.
Yeah, they're more expensive relative to their global peers than usual. And the premium of the BSE midcap index over the Nifty based on forward price-to-book ratios is also above its long-term average.
So multiple measures saying things look expensive.
Correct. And this high valuation premium just amplifies the risk. If earnings disappoint, the fall could be sharper. You're essentially paying a premium price for a market that's facing growth challenges and maybe shrinking profits.
It's clear.
Well, it's a potentially precarious situation.
Okay, that's clear. Now, shifting gears slightly, let's talk about this VMF indicator. It sounds like a market mood gauge.
It is, precisely.
Yeah.
The VMF indicator basically bundles together volatility readings from three different places: the stock market, the bond market, and the currency market.
Okay, so it's looking across asset classes.
Exactly. The thinking is when you see volatility spiking up across all three at the same time, it suggests a deeper, more widespread sense of unease, maybe even systemic risk brewing.
And historically.
Historically, when the VMF has climbed really high, say above a level of 250, it's often marked periods of intense market panic, then capitulation, where sellers just give up. And often, that panic marks a market bottom.
So what's the VMF telling us right now? Are the alarms ringing?
No, not really. Currently, the VMF indicator hasn't reached those extreme levels historically associated with capitulation.
Hmm.
So, based purely on this specific measure, we're not seeing a clear signal of widespread panic or that a major market bottom is necessarily imminent.
Okay, no panic signal there. Let's switch focus again to monetary policy and liquidity, the amount of money sloshing around the system. What's the picture there?
What we've seen recently is actually an easing of monetary tightness. This is largely thanks to the Reserve Bank of India, the RBI, taking steps to manage liquidity in the banking system.
How so?
Well, their actions have led to a situation where there's actually a surplus of funds in the banking system. You see it in things like their open market operations, OMOs, where they've been buying government securities, injecting cash,
Right.
and this has helped push down yields on government bonds, both short-term 1-year and longer-term 10-year bonds. And also the call money rate, which is what banks charge each other for overnight loans, that's come down too.
So money is generally easier to come by.
Yes, liquidity conditions have definitely eased.
And what does that mean for markets and maybe for investors?
Well, generally speaking, easier liquidity can be supportive for financial markets. It helps grease the wheels, you could say. We're also seeing that corporate bond spreads.
That's the extra yield companies pay over government bonds.
Exactly. Those spreads are currently lower than their long-term average, suggesting markets perceive less credit risk right now. The analysis even suggests that if we were to enter a proper rate cut cycle from the RBI, there could be opportunities in these spread assets, like corporate bonds.
But there's always a but, isn't there?
Well, the key thing to watch is how effectively this easier money policy actually filters through to the real economy. That transmission mechanism is always crucial. Liquidity is one thing, but does it translate into actual lending and growth?
Right. Which brings us nicely to the real economy, the underlying growth picture. What are the numbers and those high-frequency indicators telling us?
Well, the data shows India's growth path definitely took a hit from the pandemic. The services sector in particular was significantly impacted.
Okay.
And while services have seen some recovery since then, that momentum now seems threatened by, well, weak consumer demand and also that slowing pace of wage growth we mentioned.
And even IT services, which were booming.
Yeah, even the strong support we saw from IT and IT-enabled services right after the pandemic seems to be showing some signs of fatigue now.
So thinking about India's long-term growth trend, that sort of 6% target people talk about, is that looking tough right now?
Based on the current pace and these headwinds we're seeing, yeah, it looks challenging for India's gross value added, the GVA, to maintain its long-term average growth rate of around 6.1%.
And the high-frequency data backs that up.
Several indicators point towards moderation, yes. For instance, the volume of petrol and diesel being sold is kind of flatlined. Data from electronic toll collections, which tracks goods movement, suggest activity is moderating. And while the manufacturing PMI, that survey indicator, is still technically showing expansion,
Right, it stayed positive.
it has. But the actual hard data, the Index of Industrial Production, IIP, has been quite subdued. And even GST collections, while still growing, are growing at a slower rate.
Okay, a general picture of moderation. And that slowdown in wage growth you mentioned earlier,
Yeah.
across key sectors like IT, finance, auto, that must be worrying for consumer spending, right?
Absolutely. After that initial post-pandemic surge, wage bill growth in these important sectors is now slowing down, falling below their long-term averages.
And inflation's still eating into paychecks.
In many urban areas, yes. Inflation is eroding those wage gains, which naturally makes people more cautious about spending, especially on non-essential discretionary items. On top of that, there's some evidence that households have taken on more debt, they're more leveraged.
So less income growth and more debt.
Yeah, it makes it harder for consumers to really drive a strong spending recovery.
Okay, let's broaden the view again and look at India's place in the global economy. How's external trade looking?
The analysis suggests it's a pretty mediocre cycle, frankly. If you look at the growth rates for exports between fiscal year 2015 and 2025, the compound annual growth rate, CAGR, has actually fallen for most categories.
So exports aren't booming.
Not really.
Yeah.
And import growth has moderated too over that period. As a result, the overall 10-year growth rate for net trade is quite low.
And what's the global context here?
Well, this is happening while global GDP growth itself has been slowing, and growth in private consumption worldwide has also decelerated.
So even with various initiatives, India's trade performance isn't really hitting its potential right now.
That seems to be the implication, yes. It appears to be underperforming relative to what you might hope for, given both global and domestic factors.
Okay, let's shift gears completely now and talk precious metals.
hmm
There was an interesting point made about silver versus gold. What's the story there?
Yeah, it's quite notable, actually. Since around 2011, while gold prices have had a pretty strong run, silver's price hasn't really kept pace. It's lagged behind significantly.
Okay.
And this has led to the gold to silver ratio, basically how many ounces of silver it takes to buy 1 ounce of gold, becoming historically very high.
High ratio meaning silver is cheap relative to gold.
Relatively speaking, yes. And the analysis suggests this might mean silver is poised to outperform gold going forward, especially since, historically, silver often tends to catch up or even lead during strong bull markets for precious metals.
And there's a supply factor too.
Yes, that's key. We're potentially looking at the 5th year in a row of a silver supply deficit in 2025. Demand is outstripping supply.
So tightening supply, historically high ratio.
Exactly. Some analytical models even suggest silver is currently trading below its sort of implied value based on various economic factors.
What are the fundamental differences between gold and silver that drive this dynamic?
Well, gold is mostly seen as that safe haven asset, a store of value held by central banks. Silver, however, has a much larger industrial demand component. Maybe around half of its total demand comes from industry.
Or electronics, solar panels, things like that.
Precisely. Also, a lot of silver production is actually a byproduct of mining other metals, like copper or lead. So its supply isn't always directly responsive to the silver price itself.
Interesting.
So you combine that expected supply shortage, the history of silver outperforming in metal rallies, and the current high gold-silver ratio.
Yeah.
Yeah, it makes silver look like a potentially compelling opportunity right now.
Fascinating. Okay, finally, the analysis wraps up with this concept of the Ouroboros and market cycles. What's the connection there?
Ah, yes, the Ouroboros, the mythical snake eating its own tail.
Yeah.
It's used here as a pretty powerful metaphor for how financial markets work in cycles.
Cycles driven by?
Driven by basic human emotions, really greed and fear, markets tend to have these boom periods, often fueled by excessive speculation or maybe too much borrowing.
The greed part.
The greed part, exactly. The snake gets bigger.
Hmm.
But inevitably, these excesses become unsustainable, leading to busts, corrections. The fear part takes over.
The snake eats its tail.
Right, the collapse happens. But the key idea is that these collapses, while often painful, are also necessary. They clear out the excesses, the bad debts, the weak hands, and that paves the way for renewed growth and the start of a new cycle.
So it's self-correcting, in a way.
In a destructive but ultimately renewing way, yes. The lesson for long-term investors is really about understanding this cyclical nature. It means maintaining a critical perspective, maybe even a contrarian one at times, to avoid getting swept up in the extremes of either greed or fear.
And relating it to today.
Well, considering all the signals we've just discussed, the weak breadth, the high valuations, the growth concerns, it really prompts you to think. Where might we be in this current market cycle? What could this Ouroboros cycle imply about the phase we might be heading into next?
A lot to think about. So let's try to pull this all together. To summarize our deep dive today, what are the main conclusions you'd want our listener to take away?
Okay, I'd say first, despite the market rebound, the participation is narrow, that market breadth is weak, suggesting underlying fragility. Second, small and mid-cap valuations look quite stretched and potentially risky given slowing earnings and historical patterns of mean reversion.
Right.
Third, the broader market seems to be grappling with that challenging risk triad. Slow growth, pressure on margins, and still elevated valuations overall. Fourth, that VMF volatility indicator isn't flashing red panic signals right now, but it's not signaling a bottom either.
Okay.
Fifth, while liquidity conditions have eased, which is supportive, there are definite headwinds to sustained economic growth impacting earnings potential. And finally, on a different note, silver does present an interesting case, potentially undervalued relative to gold given supply dynamics in history.
And why should you, our listener, really pay attention to these somewhat complex insights?
Well, because this kind of deeper analysis gives you a much more nuanced picture than just looking at the headline index movements.
It goes beyond the surface level.
Exactly. It highlights potential risks that maybe warrants some caution, but also points to areas or factors like the SMID underperformance or the silver story that might inform strategic thinking or reveal potential opportunities. It helps you navigate the current environment with your eyes open a bit wider.
That's definitely a valuable perspective. Okay, so here's a final thought for you to chew on. Given this apparent disconnect, we've discussed the high market valuations on one hand and some of those less than stellar underlying economic fundamentals on the other. What specific indicators will you be watching most closely in the coming month to really gauge the true strength and maybe the longevity of this market bounce?
Hmm, good question to ponder.
Something to think about. Thanks for diving deep with us today.